Okay, this is our reason why I'm recording this is this also, I'm going to pass this on to another class that I'm teaching this summer as well. So we are now going to look at a couple of problems from our textbook that explain and give examples of the key concepts of Chapter 8, return analysis, and Chapter 9, discounted cash flow. Okay. Part of it is why you take accounting to come into this class. You have to know what numbers are. And that's why we talked about numbers a little bit earlier in our class, the first couple of weeks. And that's why you had that question on the assignment number 1 that Edwin was talking about a little bit earlier. You need a concept of understanding numbers in business, financial statements. If you don't have that concept, a lot of this is mumbo jumbo. That's number 1. And number 2, you have to learn to apply these to different situations. Remember, if the world were just as simple as this problem here on page 263 of the textbook, it would be really nice. Problem is the world's not shaped that way. Every capital budget case or instance has different parameters, but the basis are all the same. And that's what we're going to be reviewing, the basis of return analysis. So here's a problem on page 263 of your textbook, where it gives 2 projects, Project A and Project B. Now they keep the numbers very low on this, but you can imagine if you're Amazon and you're thinking about building a new distribution center, which they are in Ontario, that distribution center is $350 million. They want to know if the distribution center they want to build in Ontario is Project A, that's 350 million, and they have another option of building another distribution center, Project B, in Austin, Texas, for $400 million, but they only can spend on one. Which one are they going to spend on? They're going to put together analysis of the cash flow and the return that's going to be made off those dollars invested in Ontario and Austin, and compare those and see what the best method is or best result is. That's exactly what major corporations do. That's exactly what small corporations do. Should I buy a copy machine or should I lease it? That's a common question if you're running a small business. Should I rent my telephone system or should I purchase my telephone system? 2 different investment strategic decisions, both with the allocation of return and monies up front and where that return is going to be over time. So that's where you apply these 2. But we'll keep it simple in this question. Project A is an investment in an asset, and in year 0, that's today, they're spending $200. And then they anticipate generating $80 a year for 4 years as project cash flow off that investment of $200. The other project is another, keep it simple, $200, but here the project is going to be generating cash flows for 3 years at $300. Now here's a great question that you should put in your back pocket because some knucklehead professor is going to ask you this one of these days. Why is project A 4 years and project B is 3 years? The answer is very simple, and this is where accounting knowledge helps. That is the depreciable life of the asset invested in $200. The depreciable life in project A of that asset is 4 years. That's how long you can depreciate it. The depreciable life of project B in that investment in that asset of $200 is 3 years. So that's as long as your analysis is, it's the depreciable life of that investment. You might own that investment for 15 years, but the analysis to determine its viability as a return is only as long as the depreciable life of that asset. That's a key concept to understand. Okay, well, what they want us to do in this problem is say, okay, which is the better project? What is going to give us a greater return, A or B? Now, in Chapter 9, which is the end of our discussion this evening, in Chapter 9, we'll learn where these $80 come from. where these $100 come from. We'll learn how to do that. That's what chapter 9 is all about. Here in chapter 8, they give us the cash flow. We have to determine the return. So I have set up a spreadsheet to do that analysis here. And this is that file I was telling you about in week number 5. We want to determine project A, which is an investment of $200 and generating $320 into the future, and project B, another investment of $200, which is generating $300 into the future. What is better? So we have to determine what's the return of this money compared to the investment. And as I mentioned earlier, there's 4 ways of doing that that are talked about in chapter 8. The net present value method, which is to determine the return in dollars. The internal rate of return method, which is determining the return in a percent. The profitability index, which is a ratio of the return to the investment. And the payback in years analysis, which is in years, how long does it take us to pay back the $200 in years? 4 different ways. Now, why, Mr. Hassey, why do we have to do 4 ways? Can't we just do one? No, because in the real world out there, every company in their financial culture does different analysis. For example, General Electric does internal rate of return. That's their basis of capital budgeting investment. If an investment does not make 20% internal rate of return, they say nada, we're going to stay away from it. Apple Computer uses payback in years. If we can't pay our project back, the investment in 2 years, nada, get lost. Ford Motor Company looks at net present value. Some companies look at all 4. When I had my business, I looked at all 4. I wanted different perspectives. But each company has their own pet way of looking at investment returns. And that's why it's good to know all 4. As a matter of fact, in the textbook, if you want to read about it, but I urge you not to because it'll just make your head spin, they talk about 2 other analysis as well. Marginal internal rate of return and the discounted payback in years. But trust me, the real world shies away from those 2 examples. This is the big 4 of investment return analysis. If you were sitting at a bar in Midtown Manhattan, having a cocktail at the end of a workday, which is in the main investment area of Manhattan, and somebody walks in and sits down next to you and they say, "How was your day?" "Well, it was a tough one. I just determined that we had negative net present value off a potential investor." And that person next to you at the bar will buy you a drink because they'll say, "Damn, you have had Hassey in finance. You know what's going on. I'm going to buy you a drink. Wow, where are you from? Oh, you're California? All right, that's good you know that because you know what's going on in your business." All right, enough of that. Okay, so let's take a look at this. Again, we're given the project cash flows. Now, what is these $80 and $100 represent? They represent net cash flow of the project, which is net income, revenue minus expenses, plus or minus working capital investment, plus depreciation add back, and plus any salvage value or disposal value that you anticipate at the end of the project's life to recoup some of the costs of the invested asset. This $80 and $100 is all made up in these crazy things. Net income is the net accounting income, but then we add back in or subtract working capital, depreciation, and salvage value, and we'll look at that in chapter 9. So don't worry about that now. Another key area of this is, okay, we want to take these future cash flows and compare it to today's investment. Well, how do we present value these numbers back? We have to have what is called a cost of capital. What did it take us? What did it cost us to get the $200 that we invested in this Project A asset? Where did that money come from? Did it come from the issuance of debt? Did it come from the issuance of equity? Or did we take some of our prior year profits and took that out of whatever it was invested at and use that to fund this asset? Where did it come from? And this is what chapter 10 is all about, how to determine the cost of capital. But that's next week. But in this particular problem, it cost them 11% to get the 200 bucks. That's what is called the discount rate. It's also called the hurdle rate. It's also called the weighted average cost of capital. Different ways means the same thing. So here we go. Project A is bringing in $320 over 4 years. What is this $320 valued at today? It's called the discounted cash flow. And this is where spreadsheets are a godsend. Formula, function, financial, net present value, NPV. That's your function argument. Bring that up. What's the interest rate? It's our cost of capital. In this problem, the cost of capital is 11%. What is our cash flow values heading out into the future? Right here. So all I have to do is paint from year 1 through year 4. And it's taking those cells, B5 through B8, and including it into this calculation. So what this calculation is doing is taking these $80 for 1, 2, 3, and 4 periods into the future and discounting them back to today at 11%. And if I hit the OK button, $248.20. So in other words, this 80 bucks or $320 being received in the future is actually worth today, discounted at our cost of capital, $248.20. So the number we're looking at is the net present value number, which is this discounted cash flow added or determined as what's the difference between that discounted cash flow and the investment. Sorry. $48.20. That's the NPV. The good thing is it's positive. We're making money over the life of this, over the depreciable life of this asset. So let's do this for Project B. Formula, function, financial, net present value is our calculated tool. Again, the interest rate or cost of capital is 11%. And the values here are over 3 years, C5 through 7. So now it's going to take that $100 into the future. What is it worth today? $244.37. The difference? $44.37. So based on this analysis, Project A is the project you would want. It's making more money. Not much more money, but if you put this in millions of dollars, that's quite a bit of chunk of change. The net present value is, in English, is the discounted cash flow related to the investment, the difference. The discounted cash flow at the cost of capital of that project taken against the investment, what's the difference? And in this case, it's positive $48.20, $44.37. We're using the NPV function to determine the discounted cash flow. Matter of fact, in assignment number 2, you're doing this work as practice. Hint, hint. Okay. That's the net present value method. In dollars, what's our return to their investment? Taking into account the cost of money. The next level of return analysis is in percent. What is this as a percentage of the investment? It's called the internal rate of return. Let's see what it is for project A. Formula, function, financial, and now we have an IRR function. It's called IRR, which will automatically determine the return in a percent. Internal rate of return, IRR. So I bring up that function and it's very simple. I don't have to put in any interest rates, nothing. I just put in the values. Now the values have to go from year 0 to year 4. I'm including the investment year and the 4 years of cash flow. So it goes from B4 to B8. I'm taking that as determining the return on investment. Hit OK, 21.86%. So if this was General Electric, they would approve it. It's over 20%. 21.86% is the return on this investment over its depreciable life. If I do this for project B, same way, formula, function, financial, IRR. See, here's the thing that just drives me nuts. When I was in undergraduate college, we didn't have spreadsheets. We had to do this on a friggin', I'm not even going to tell you, a slide rule. You guys ever seen a slide rule? I had to do these friggin' calculations on a slide rule. That's how old gangster I am. No spreadsheets. You guys got it made in the shade. All right. So I bring this up again.
Professor.
Yes, Edwin.
I was just taking a shortcut on the net present value, dividing the 4820 by 200. That gave me about 22%. I mean, I know that's just, but it's just in my head, I was doing that.
Yeah, that's how you get it's actually 21.86%.
Okay.
You're close. Okay. So if I do that for project B, again, year 0, in this case to year 3, you're going to be shown something a little bit interesting. The answer is 23.38%. Why? We're getting the money quicker.
Shorter span of time. Right?
Shorter span of time. Whereas project A is generating more dollars, we're getting those dollars back quicker in project B. Thus, if my company wants the money faster, they're going to probably do project B. You're getting a higher return on that. But if you want more dollars, project A. It happens a lot. That's why we have these 4 different ways or perspectives of looking at information. Okay. Internal rate of return, percentage. Now it gets easier, much easier, these last 2. The profitability index is a ratio. What's the ratio? The relationship of the discounted cash flow to the investment. What's that relationship? Naturally, hopefully it's over 1, and the more over 1 it is, the better. So all I have to do is type in the ratio. equals the discounted cash flow divided by, and I'll make that negative, the investment to make that a positive, and my ratio is 1.24. Now, some textbooks and some circles say the profitability index is the relationship of the net present value to the investment, which is nothing wrong with that. It's just taking a look at it a different way, and there's nothing wrong with that. Get rid of that dollar sign. Either way is fine, but I prefer the discounted cash flow over the investment. Either way is fine. You just want to see the perspective of that relationship. So the same thing will hold true for project B. Let's just slide these numbers over. Whoops. There we go. Now notice project B is just like the net present value method. This is based on money, so the ratio is more positive for project A than project B. Now the payback is how fast do you repay the $200. First year, 80 bucks. Second year, 80 bucks. That's $160. We still have $40 yet to pay back. So $40 of year 3 will give us the $200. 180, 160, and $40 gives us 20 bucks or $200. So 2.5 years. It's that simple. 2.5 years to pay back in this project. 1, 2.5. It's even simpler for project B. 1, 2. 2 years. So in the case of this particular example in chapter 8, when we're looking at the dollar return, net present value and profitability index are showing it project A as the likely choice. But we're looking at how fast we get the money back, internal rate of return and payback, project B looks the better. Two different perspectives of looking at it. And you run into a lot of this in business. Here's a point for future notation. Note the cost of capital is 11%. If I reduce that cost of that money to 8 or 7%, I make more money here. An important concept in business. The cheaper the money, the greater the return. That's why companies today are freaking out. Money is becoming more expensive. They're not making as much money as they did when money was cheaper a couple of years ago. That's why the Federal Reserve is getting into action by increasing the interest rates to make that more of a competitive field in money costs, to make the supply of money increase to cover those costs of additional dollars of expense of what it takes to borrow money these days. And we could talk a whole class about that, but we won't. Okay. So, sirs, gentlemen, this is what chapter 8 is all about. Explained in Mr. Hassey's own derelict way, instead of reading all that gobbledygook they give you in the chapters. This is exactly what you need to know when I say, okay, put together a net present value analysis, put together an internal rate of return analysis, put together a profitability index analysis, put together a payback analysis. What do those numbers tell you? That's what you need to know from chapter 8, how to do these 4 calculations. We're going to take a little break for a minute. When we come back from our break, Professor Hassey's got to go to the can. When we come back, we're going to learn in chapter 9, how did you come up with these numbers? Where'd they come from? How did you determine the net cash flow? That's what we're going to look at in problem 14 at the end of chapter 9. Anybody have any questions about this initial look at the real cool world of corporate finance?
Yep. So far, so good.
Good. Okay. So again, I'm going to repost this file back to Blackboard when we're all done. But that's a start. Okay, now give me 10 minutes. We'll come back in 10 minutes to take a little break. Smoke them if you got them. Have a nice cocktail if you'd like. I don't care. And then we'll come back in 10 minutes and do our chapter 9 work, which looks like this. Ooh. Now we're going to determine these net cash flow amounts in our problem.
Awesome.
How do they come up with those amounts? And then we're going to, again, do another of these 4 analysis as further practice. So we're going to look
Okay.
at that when we come back from break. So I'll see you all back at 6:35 p.m.
Okay.
Alrighty.
Thanks.
See you later.
Perfect.
Adios. You gotta love 70s music. I'm telling you, you gotta love it. 1970s. Ah. All right. Now we're going to be taking a look at the key concept of chapter 9 is how do we determine operating cash flows of a project? And we're looking at the bottom of page 296 and the top of page 297 of your textbook. Project evaluation. Here they give us a bunch of variables. Our job as financial managers is to take these variables and put them into a format that tells us how much cash flow is being generated here on an investment of $45,000. This project is an investment of $45,000 in plant and equipment, and it's generating the following revenues for its depreciable life of 4 years. $40,000, $30,000, $20,000, and $10,000. That's the revenues. The expenses are expected to be 40% of revenues. That's the plan. 40. So if our revenues are 40,000, 40% of that are expenses. 20% of revenues are our working capital requirements. So our job is to determine, with an investment of $45,000, what is going to be the net project cash flow of this project with a straight line depreciation over 4 years with no salvage value of an investment of $45,000 and a company tax rate, ouch, of 40%, and a cost of capital of 12%. What is its net present value and what is its IRR? I can't think of a better way to look at assignment number 3 where you have to put this sucker together, because it talks about accounting and finance and financial return analysis. So I have set up a spreadsheet for us to do this. And here's that spreadsheet. Okay. And this spreadsheet is going to calculate. This is the key down here. This is what we have to come up with. The net project cash flows. That's the subject of all this work, is to come up with this bottom line. And once we have this bottom line, just like we did in the last problem, that bottom line is the $80 or the $100. In this problem, we're coming up with the bottom line. And once we have that, we can do this analysis. Last night I couldn't sleep very well. The fireworks the night before and the animals going bonkers and climbing up the walls. And then last night, the Colorado Rockies are horrible with the Dodgers. I kind of like Colorado, so I'm depressed about that. Couldn't sleep very well. So you know what I did? I got up about 2 in the morning and I went to my computer and I put together a cash flow analysis. It gave me a nice perspective of things. It was a good way of calming myself down. Now you might say, Professor Hasse needs to get a life. But by doing a project cash flow analysis, it gives you as a manager a clean perspective of what you're doing with a particular investment. You're actually knowing where all the money comes from. I'm sure when you are doing your personal budgets and your family management, you feel a lot better when, even though you may be spending more money than you're earning, at least you know what you're spending it on. That gives you a little bit better perspective of how to manage this. All right, so in this project, they're telling us that our investment is $45,000 in year 0. We're generating $40,000 in year 1 in revenues, sales. $30,000 in year 2. $20,000 in year 3. And $10,000 in year 4. And that our expenses are 40% of those revenues. Again, the key to this, and you'll get problems where these variables are given to you in a different way. The key for, as being a financial manager and putting this together, you got to understand what the variables tell you and where to place them. That's a big part of this. So I'm going to say that 40% of my sales
16, right?
Are my expenses. So I'm taking the revenues times negative 40%, $16,000. There's my expenses. And I'm just going to copy that all the way down. And there's my expenses based on the variable of 40% of revenues. What's my depreciation? Well, remember the investment is $45,000 and there's no salvage value. So notice this over here. I'm taking $45,000 and dividing it by the depreciable life of 4 years.
Straight line.
Straight line depreciation. $11,250. That's my depreciation expense. Cool. Every year. So I'm fully depreciating the asset over its depreciable life. And there's no salvage value. Now, if there was salvage value, that'd be a little bit different thing, but we'll talk about that next week. So now I have all the ingredients to determine my earnings before taxes. It's the sales revenue plus the negative expenses, plus the negative expenses, and plus the negative depreciation. There's my earnings before taxes. Didn't we do that in assignment 1? We did. Cool. And let's just slide that all the way down. And notice we're seeing something interesting here. In year 4, when our revenues become only $10,000, we lose money in year 4 in this project. How about that one? Now we have to take 40% of our earnings and pay Gavin Newsom and Joe Biden. All right, we got to pay those boys. Keep them off our backs. So we got to pay our corporate tax. Now, right now in the real world, the corporate tax rate, if you're a
25.
California company, is around 25%. But well, I like the 40%. I like the good old days of overspending in government. So let's say 40% is our tax rate. So all we have to do now is do this formula here, equals our earnings before taxes times minus 0.4. And there's our taxes. And let's slide all this all the way down. And cool, notice in our year 4, when we lose money, we get a refund. Positive cash flow of $2,100. Sometimes students miss that baby. If you lose money, you get some of that money back as a refund. And that's what they're getting here. So now we can come up with our net income, our net accounting income, which is our earnings before tax plus the negative income tax. And there's our accounting income. We're still losing money in year 4 with that refund, but we lost money in year 4. All right. Now let's skip ahead. Let's add back in depreciation. We add back in depreciation to our calculation. Why? Because this expense here is non-cash. Cash, cash, cash. Spending money. We're not spending any money to Mr. or Mrs. Depreciation here. It's an accounting entry given to us to reduce our tax liability on this asset that we're depreciating over 4 years. So we add that depreciation back, just like we did in cash flow from operations in assignment 1. Depreciation is added back as positive cash flow. Give you a little bit of economic history. Even though he was a wonderful man, he sucked as a president, Jimmy Carter. You guys probably weren't even born then, but Jimmy Carter. When Jimmy Carter was president, you talk about 7 or 8% inflation today. Jimmy Carter, the inflation rate was 16.5%. Ouch. We were running out of gasoline. There was no gas. There was nothing. It was a disaster. So poor Jimmy was shown the door. But when he left and Ronald Reagan became president, Ronald Reagan had to do something very quickly to get the economy going after those disaster years of the Carter administration. I voted for Jimmy Carter, though, and I'm glad I did. But I didn't vote for Ronald Reagan, and I'm glad I did that too. But Ronald Reagan did a good thing. His first couple months of his administration in 1980, here's what he did. He immediately told the Internal Revenue Service to get more money back in the hands of the corporations in America. What did they do? They increased the depreciable tax rates. They made it higher depreciation on assets. By depreciating more, creating more expenses, lowering the tax returns by giving them tax breaks, at the same time giving them cash flow, that money was available to be reinvested back into the businesses and create growth. Immediately within 2 quarters of that change in the depreciable schedules in 1980, the economy began recovering, and it didn't stop until George Bush #2 was president. That created massive growth through the 80s, the 90s, into the 2000s. And it basically ended with the crash of the real estate market in the 2000s. That's how that's happened.
So,
Yep.
Just a quick question on that observation with Carter. I mean, presidents usually avail themselves of economic advisors. I'm always wonder why he didn't get the advice, or did he do something and then Reagan got the credit for it?
Well, no, Jimmy, here's what Ronald Reagan wasn't a very smart guy, but he was smart. He hired the right people. Jimmy Carter was a smart guy, but he hired a bunch of idiots. That's where he got into a problem. And you guys probably know this from your own businesses. You know, you have some bosses who maybe are just great bosses because they let their people who are good people run the show and they keep their mouth shut. But then you got other bosses who micromanage and want to do everything, and things are friggin' disasters. Jimmy Carter was a micromanager. And it was you don't run a $1 trillion economy with a micromanager. You can't do it. And that's where he got into problems. Simple as that.
Yeah.
Ronald Reagan didn't know the difference between a dollar and a peso, but he hired the people who knew the difference between a dollar and a peso, and they fixed it. And he naturally gets the credit, which rightly so. He hired the right people.
Right.
Poor Jimmy hired a couple of real buffoons, and that's what happened.
That makes sense.
Yeah, it does. But so depreciation is a big deal. So there we're adding back depreciation. Now, let's look at this working capital line, and this is very important. I'm sure all of you have bought with borrowed money or bought assets over time. What happens when you buy a car? Let's say I go out and buy a new car, and these days a new car is going to cost you about 60 G's, a decent car. And then if you want to go electric, it's even more than that. But let's say 60,000. So when you go out and borrow money and buy a car for $60,000, is that the end of your expenses on that car? No, you're just buying the asset so you can drive around. Still, you got to spend money on registration, insurance, maintenance, whatever. The money doesn't stop. That's called working capital. That's the definition of working capital. The additional outflow of money to keep the asset, the car, on the highway. That's working capital. And you got it. That working capital will get replenished over time with the profits and the use and the generation of return on that asset. But you have to put upfront money to cover that until you get reimbursed. And that's what working capital is. I'll tell you, in California right now, 3 out of 5 new businesses fail within 18 months. And they don't fail because they have lousy ideas or they're not smart. They fail because they're undercapitalized and they don't have enough working capital to get through the period until they start generating returns. They're undercapitalized. If any of you guys are going to start a business, my only advice to you is make sure you have adequate capital to fund you for at least 2 years. If you do, you're going to make it. But if you're undercapitalized, it ain't going to happen. That's what working capital is. You got to have money in addition to purchasing the assets and starting the business to get going. So here in this problem, they tell you that working capital is, let's go back to the problem here so I can show it where it is in that problem. Because there's a lot of variables here. It says here, where is it? Yeah, it says here, working capital, there it is right there, is expected to be 20% of revenues of the following year. Working capital is 20% of the revenues of the following year. In other words, if I have $40,000 revenue, my working capital is 20% of that, $8,000. If my revenues in year 2 are 30,000, that means my working capital has to be $6,000, and so on. Now, in the real world, it's done this way. You have public accounting firms and consulting firms and risk managers and all kinds of people in your business that tell you what that working capital rate should be, and you plug it into this analysis. So 20% of the next year's revenues, that's important. This is a big deal. This is where most students get confused because they say, working capital, what is that? Remember, working capital is the difference between current operating assets and current operating liabilities. That's working capital. So let's go back to our spreadsheet. I am on fire tonight with this stuff. You can just tell I'm on fire. Hurts. Okay. So what's working capital? Well, we just said 20% of the following year's sale. So in year 0, if we take $40,000 of the next year's sales and multiply that times negative 0.2, we get $8,000. So now we have an additional $8,000 of cash that we have to come up with in year 0 to get this sucker off the ground. Now, in year 1, what is our working capital? Well, we know in year 2, 20% of 30,000 is 6,000 bucks. So now we only need a $6,000 balance in working capital. Well, all we have to do then is just add $2,000 back of working capital to make the net $6,000, which is 20% of the following year's revenues. Remember, working capital is not operating expenses, it's assets and liabilities. So it's an ongoing balance sheet. In year 2, what is the following year's revenues? $20,000. 20% of 20,000 is $4,000 now is our working capital balance. So we have to add another 2,000 back as positive cash flow to get to our $4,000 balance in working capital. Year 3. By the way, people do this for a living and get very well paid for it. Kind of creepy when you think these people are walking around in our streets. Okay, so 20% of $10,000 is 2,000 bucks. So now we got to add back in another $2,000 as positive cash flow in year 3. So what's our working capital balance now? $2,000, matching the following year's sales commitment. And then in year 4, there's no more sales. We're done. So the rule of working capital is this working capital has to be fully used during the life of the asset. So that means another 2,000 is added back in year 4. And now we've refunded all the working capital back with cash flow. The balance is 0. Now we can calculate our cash flows total. Investment, working capital requirement, we're spending $53,000 in the initial year as an investment in this project. Year 1.
So,
yes, question.
Professor, so just a quick question on the working capital. Is that something that should be allocated at the time of the investment
Yes,
to have that?
yes.
Okay.
Because it says, okay, we bought the investment, we bought the equipment now in year 0. Now we got to get it ready to put into production. So we're going to have to spend an additional $8,000 on whatever, maintenance, computer programming, whatever, to get it up to speed so we can sell the product in year 1.
Got it.
And if you look at any investments and investments, when you buy a car, can you drive it right away? Unless you can't, unless you have insurance, registration, that's additional cost to get the car on the streets, right? That's where you kind of get that. Makes sense.
Gotcha.
So in our year 1, it's net income plus the working capital plus the depreciation. $20,900 of cash flow being generated in year 1. Oh, I like the sound of that. And then we just slide that over for all the remaining years. And there's our project cash flow. Net income, net accounting income, plus working capital, plus depreciation. We're generating off this investment. Well, let's sum that up just so we can see it. We're generating $62,000 return in cash flow off this investment of $53,000. So not only is the investment in year zero, as Edwin indicated earlier, the investment in the asset, it's also the working capital requirements needed to get that asset up to snuff to begin operations. Now we have all the pieces just like we had in chapter 8. Now we got all the numbers where we now can go ahead and do our return analysis. They tell us in the problem that the cost of capital is 12%. Ouch, it's expensive. 12%. Jimmy Carter must be in the White House. Okay. So what is our discounted cash flow? Formula, function, financial, net present value, NPV. The good thing about this, I'm recording it. You can go back and look this over again, which might be helpful. So what is our cost of capital? Here it's 12%. That's our rate. What's our values? Well, again, we paced year 1 through year 4. So it's C14 to F14. That's our values for project cash flow for those 4 years. We hit OK. Uh-oh, I smell a rat. Our discounted cash flow is only $48,622.29. That means our net present value, which is the difference between the investment and the discounted cash flow, we get to see our first loser, negative net present value. At this high interest rate and these amount of income, expenses, taxes, project cash flows, we're losing money. This is what is called in the business a dog with fleas. So if anyone ever tells you, hey, this is a dog with fleas, yeah, you'll know what they're talking about. It's negative net present value. You stay away from it or you fix it. Let me tell you something. In 1979, Apple Computer was getting ready to go in to begin the investment process of the new iPhone. It's still years away, but they were beginning it. And they put together a capital budget analysis of the investment of $400 million to develop the technology, which was not yet invented yet, and the distribution capability of the iPhone. And the original plan was to build the iPhone in Palo Alto, California. They put together their spreadsheets just like we just did. Naturally, the depreciation schedule was for 20 years, but it came out to be negative net present value. Steve Jobs almost had a heart attack. What the F are you guys doing? This is coming to market. I don't care what you guys do, but make this profitable. And you know what they did? They got on a little airplane and went to Beijing, China, and said, hey, dudes, can you guys build this product here in China? Yeah, we can do this. They cut their costs by 80%. And now the iPhone was going to be a positive net present value. And that's what started it all. To build it in China made it profitable. If they built it in the United States, we never would have gotten an iPhone. Wonder why companies build products in Mexico, India, Indonesia. Makes sense. Cheap labor, no taxes. They want your money there. They want you to hire their people at 10 cents an hour. They don't care. That's how this all went down. The financial people at Apple said, Steve, we can't build this in California. We need to build this elsewhere. You better find another place to get rid of all these costs so we can make money. That's what happened.
All the politics involved in bringing jobs back, the bottom line is that the net present value doesn't
Exactly.
add up. You're going to go out.
Okay, let's take a look. What is the internal rate of return we know is going to be a disaster on this. Let's see what it is. Formula, function, financial, internal rate of return. There it is right there. IRR. Now remember, all we have to do here is paste values. Year 0 to year 4. This has got to be far south of 12%, and it is 7.5%. Now this confirms it's a dog with fleas. The money is costing us 12%, and we're only returning 7.5%. Get the hell out of here. No way, Jose, on this one. Profitability index. We'll go ahead and do that. Again, profitability index is the relationship of the discounted cash flow divided by the investment, and it's going to be less than 1. It is. That's another indicator of a dog with fleas. It's under 1. We're not even getting our money back. And the payback period? Well, let's see what it is. We're investing $53,000, and at the end of year 1, we're bringing back $20,900. We still got $32,100 at the end of year 1 to pay back. Well, we take that 32.1 and we add in the year 2 cash flow. Still got $14,800 to pay back. Slide that on down. Well, it looks like we pay it back finally in year 4. How much of year 4? 1, 2, 3. Well, we have $1,100 to pay back in year 4, of which we have a total cash flow of 10.1. What percent is 1,100 of 10,001?
About 10%.
.11. So our payback in years is 1, 2, 3.11 years. Damn. Mr. Hassey, you make this so easy. I know I'm going to do this and I won't have a friggin' clue what's going on. That's why we have this video. And also, I've been doing this for 40 friggin' years, and I did it on a slide rule. How about that? How do you like me now? Okay. So, gentlemen, we have just covered our first 2 chapters, 8 and 9, of understanding capital budgeting. We've looked at the 4 different examples of net present value, IRR, profitability index, and payback, which are the 4 examples of return. And now in chapter 9, we've learned how to assess variables into a, remember when we started out, this was all blank. Now it looks like we really know what we're doing. And we've taken and determined our net incomes. We've determined other other cashable cash flow items. We've determined our net cash flows, and we've done the analysis that in this case, this project is a dog with fleas. Back to the drawing board for this company. If you allow this to go to market, somebody's going to get their head handed to them on a pole, because you're going to have members of your board of directors going, why are we authorizing the spending of this money when we're not going to be making any money? Who's the knucklehead that approved this? All right. There it is. Take a look at this over the weekend. You don't have to worry about this as far as assessment until assignment 3 is posted next Wednesday. But this is what you got to chew on over the next few days to make sure you got a handle on it.
So to extrapolate this could be a $45 million investment.
Exactly.
Yet the percentages are about the same, right?
They're about the same. If you just add 3 more zeros to this and 3 more zeros to everything, it's basically the same. Just the numbers are bigger.
Right.
Or add 6 more zeros, which is the real world. Okay. A dog with fleas still has fleas no matter what size the dog is. Oh, that's profound. Okay. So this is where you guys have to read. Now, what I've done is in the Blackboard now, I'm going to post this as solutions week 5 class review. So you still have the blank spreadsheet in your week 5. You could download that and try to do these problems yourself and see because you got the answers here, you could do the problems yourself and see, well, how come Hassie got this and I got this? What did I do wrong? And then you can go back and see where the formulas are or what you did. So that might be a handy little tool for you to do as a review of this. And then my video this weekend will give you another problem to practice on, which is another example of different way of looking at variables, same format, but the variables are given to you a little bit differently because that's what the real world is. Not every problem's the same. And so we'll look at that in my video to you this weekend, and you'll have another file folder or a spreadsheet file that you can practice that on as well. So by the time next week rolls around on Wednesday, assignment 3, you'll have all you need to put together that sucker. And I will provide the spreadsheet for you in that assignment. You'll just have to put in the pieces of the puzzle and the formulas, but I'll give you the format in a spreadsheet so you don't have to construct all that. I'll give you that. But we'll talk more about that over the weekend.
Okay.
Gentlemen, any questions?
I'm good.
Boy, we
No,
did a
too
lot.
bad.
We did a lot tonight. This is cool. You
Yeah.
can walk out of here and your wife or your partner or your kids will say, hey, how was class tonight? I know what a dog with fleas is. Shut up.
I was gonna say I got my ROI tonight.
Exactly right. Okay, guys. Well, we'll meet again next Wednesday. Look for my weekend video this week, either Saturday or Sunday. But try to download this file in week 5 and try to practice it if you can. I know, Jaime, you still have to do some work on assignment 2.
Yeah.
But finish that up this weekend or into next week, and then take a look at this and begin to look at study this. And there are also some good videos in week 5 explaining this process. So you might want to take a look at that as well. Okay.
All right. Sounds
Great.
great.
Thanks, Professor.
All right, guys. Have a good
Good night,
weekend. I'll
Jaime.
talk
Good
to you
night,
next week.
Professor.
You too. Enjoyed the music.
Okay.
Great music.
All right. See you
All right.
later.
Good
All right.
night.
Take care. Bye-bye now.